That's pretty much all of Scion's liquidity. Michael, this is highly distressing.
Lawrence, that is not all of our liquidity. And I'm not certain that you really understand this trade. This is a certainty.
Mike.
This is a certainty.
Mike.
This is a certainty.
Many people have been surprised recently by the rising share price of GameStop. Many people, that is, except for Dr. Michael Burry. The famed Big Short investor cut his GameStop position by 8% in June 2020, which meant it was no longer the largest position in his portfolio. That accolade went to his Google call options. Nevertheless, at the time of his June the 30th SEC filing, Michael still owned 2.75 million shares in GameStop for a total investment of $11.9 million. GameStop's share price as of Monday the 19th of October is $13.31 per share, which means that $11.9 million investment is now worth a cool $36.6 million. Even without call options or any of the derivatives that investors take advantage of, just on share price appreciation alone, Burry has made $24.7 million from GameStop. So, why has the share price gone up so much recently? Despite all the naysayers, what did Burry see that others missed? And crucially, will this performance continue, and is it too late to buy GameStop shares now? Coming up today on Finance in 5. While Burry is thought to have made over $24 million in 2020 alone from the share price appreciation of GameStop, Chewy founder Ryan Cohen, who accumulated 5.8 million shares at between $4.60 and $6.18 per share, has already seen his stake more than double and has gained over $47 million in profits from an initial investment of just over $30 million. In spite of these returns, and as far as I understand what is happening within the company, neither investor is likely to liquidate their position in the immediate term, and there has been speculation that Cohen was considering buying out the company. This is something that I will return to later. So which events have unfolded recently which actually exaggerate the bullish case? Well, there are several, and each one makes it more likely than ever that the gains witnessed so far, as huge as they are just the beginning of the run-up for GameStop. In the first place, the reason for the big spike in price recently has been the announcement of GameStop's profit-sharing agreement with Microsoft. This information is taken from a Seeking Alpha article written by Justin Dopierala, who has been bullish on GameStop for many months and has written a number of articles explaining his thesis. Here we see information relating to the recently announced subscription model for gamers. It says, if a customer signs up for the $15 monthly Xbox Game Pass Ultimate at a GameStop store, we would expect GameStop to receive $1.50 or so from that monthly revenue stream for as long as the customer continues to subscribe. If instead the customer signs up for Xbox All Access for $35 a month, GameStop would share $3.50 per month for 24 months. The guy who wrote this article, Mr. Patchter, believes that this will not drive meaningful upside for GameStop. However, Justin Dopierala disagrees. According to what he writes here, the Xbox S costs $299 and the Xbox X costs $499. We can see from Q3 of 2019, the last point new hardware sales were broken out, that GameStop had about 10 to 11% margin on the sale of new hardware. Let's assume 10%. This means GameStop makes $30 to $50 on the sale of every Xbox S and every Xbox X. However, what would happen if the customer, instead of actually buying a console outright, instead opts to buy nothing up front and take advantage of the All Access Xbox offer? On the Xbox S, the cost is $25 a month for 24 months, and on the Xbox X, the cost is $35 a month for 24 months. So according to Michael Patchter, who wrote this article, he would expect GameStop to earn $2.50 to $3.50 a month from each sale. But here's the thing, over the course of 24 months, that would total $60 to $84 per sale instead of $30 to $50. So while the revenue stream will take longer to realize, GameStop nearly doubles their margin on the initial sale of the console while still realizing additional profit from the purchase of new games and accessories. As well as that, most subscribers are likely to extend their Game Pass Ultimate subscription beyond the 2 years after the console is paid for. A second 24-month subscription would essentially have the same effect as GameStop selling an additional console over the next 2 years to the same person, as GameStop would realize another $18 per year per gamer over the following 24-month period, as the Game Pass Ultimate subscription is $15 a month. The Xbox One has sold 48 million units. GameStop is going to sell tens of millions of the Xbox X's, but let's assume they only sell 5 million Xbox X All Access subscriptions to users that then extend the Game Pass Ultimate subscription for another 2 years at a cost of $360 or $15 per month. $360 times 10%, that's 5 million customers, that's 180 million. So that's correct. In years 3 and 4 combined, if just 5 million customers extend the subscription for 2 years, GameStop makes an extra $180 million in incremental profit with zero cost involved. And that's nearly a quarter of GameStop's current market cap in terms of recurring income, which is a massive, massive number. So you can see this is the whole reason why this particular author is bullish about what the future holds in store. In fact, GameStop is by no means the only retailer to pivot towards a monthly subscription model as a way of recapturing market share while the economy opens up following the health issue that we hear so much about. Aware that time and disposable cash are at a premium, Pret a Manger is offering a takeaway drink subscription service which allows customers who pay £20 per month to receive up to 5 hot drinks per day by scanning a customer-specific QR code in-store, which is emailed to them upon sign-up. The only proviso is that they have to consume these drinks 30 minutes apart, so that people don't abuse the service. They're hoping that while this model is a loss leader, shoppers are likely to make other discretionary purchases in store, such as buying lunch items or snacks, perhaps casually forking over £1 or more for about 25 grams of chocolate which you can buy from Pret, which is where Pret really makes its money. The same principle holds true of the GameStop model. While it has its advocates, certain people will never sign up to it because various titles of games will always be unavailable on that service. But that doesn't change the fact that it's an entirely newly generated stream of revenue that continues on in the background, whether or not customers make additional discretionary purchases. This is how a company turns its fortunes around, and it's also how customer experiences are optimized. I find it hard to escape the conclusion that Ryan Cohen will have been instrumental in bringing this subscription model to fruition behind the scenes.
And I think everyone underestimated how well we would execute and how big of a business we could build.
You're still going up against Amazon.com.
Yeah.
That is a confident man, people, yes.
Since it's very much the mainstay of e-commerce, which relies heavily on repeat customers to drive profits, and which is his background, all of those recommendation emails that you get from Amazon are not accidental, and they certainly don't allow the rich volume of browsing data to slip through their fingers untapped. By knowing your purchase history, they're able to nudge you towards a follow-up purchase. Getting people to sign up to a service, sending them emails and questionnaires are just some of the many ways that Amazon and other retailers keep you within their ecosystem buying and buying. On GameStop's latest 10Q, they hint at selling the European arm of the business. There's a headquarters in Milan, as well as other offices in other countries. Selling the European real estate would cut significant costs on these non-productive assets. GameStop wouldn't need lawyers or accountants anymore, nor would it require marketing teams, and that would lead to a material decrease in capital expenditures. GameStop won't need to spend money on maintaining that store base, and whoever the buyer is can decide how best to operate the assets going forward and what the footprint should look like. While there's no guarantee of the timing of when this would occur, it probably would have an extremely positive reaction from investors. Some short sellers in financial media like Barron's have expressed how perplexed they are at the increase in the stock price of GameStop on the back of the revenue sharing agreement with Microsoft. They don't seem to understand that the deal could bring that much value to GameStop to justify the rise in price. However, the increase in the GameStop price isn't a reflection of the value of the strategic partnership. It's more a reflection of a change in investor sentiment. GameStop, even at $9 a share, or perhaps $12 a share, is priced for bankruptcy, especially when you consider how high its share price has been historically. Cash on hand is worth over $12 a share. Net cash is worth over $5 a share. The market wasn't ascribing any value to GameStop's future cash flows. So as investor sentiment continues to shift, however, and coincides with a significant change in the company's fundamentals in the form of big increases in profitability and cash flow, the upside potential for GameStop is huge, even if there's no short squeeze. The SEC requires shareholders of 5% or more of the company's shares to file promptly, disclosing any material change in shares, with no amendments filed by last Friday night. Unless something appears today on Monday after the bell, shareholders can be assured that Donald Foss, Must Investment, Hestia, and Ryan Cohen, and probably Scion Capital, have not yet sold any material amount of shares during the recent run-up, despite massive volume. Ryan Cohen's filing shows that he spent $38.8 million to purchase his 6.5 million shares. Although we know about most of his purchases, there was a material amount of shares that he probably started to buy in early 2019. We know this because his filings show 4.3 million shares purchased at an average price of $5.23. Therefore, the remaining 2.19 million shares had to have been purchased at an average price of about $7.47, which would date those initial purchases back to May 2019 or even before. Which means that he hasn't been deliberating on GameStop for just a few months since August, but actually for at least 15 months, probably more like 18 months. And his lack of selling only further proves his motivations and intentions. He isn't in GameStop for the price to double or treble. He knows the true value of GameStop is worth a lot more than that. He knows what the long investors have always suspected, which is that they're going to win, regardless of how long it takes. The only question is how deep would the short sellers dig their own graves, as Justin Dopilara says. Almost anything's possible here, apart from GameStop going bankrupt. Bondholders currently ascribe zero chance of GameStop going bankrupt by 2023 because both of GameStop's 2021 and 2023 bonds now trade above par. Therefore, the short seller thesis is dead. GameStop is not Blockbuster. So what's going to happen? We'll have to see. Will the short sellers cover willingly at $12 to $20, or are they going to wait until they're forced out at $100 or $1,000? Time's going to tell, but the story is far from over. If you've enjoyed this content, please consider watching my other videos and subscribing to the channel. All the very best.